now, even at CPAs don't even know how to help people save money on taxes.
Really?
Yeah.
Is it true Native Americans don't pay tax?
So I'm not gonna say they don't pay tax, right? But they do have.
I heard that too.
Yeah.
They do. There are some benefits
To be a Native American.
Yeah, to be a Native American.
So I'm Native American too. You are.
I'm not gonna go down that rabbit hole. Not like when the tax code was created. There's over 70,000 pages in the tax code, right? Right. So if you were to print out the whole tax code, that's
it would
almost
be
like
the size of this room.
literally longer than that, right?
Do you have to read it all?
Right. You're asking if I had to read it all?
Have you read it all or
I
something?
haven't. Listen.
You probably read.
Welcome back to the Digital Social Hour. I'm your host, Sean Kelly. Here with my co-host, Wayne Lewis.
What up? What up?
And our guest today, Michel Valbrun.
What's happening?
How's it going?
What's up,
Amazing,
man?
y'all.
It's
Good,
the tax guy.
Yeah, that's what I do. Money making Mitch, man. Help y'all keep the bag is what I do, y'all. So yeah.
So how would you help athletes keep their bag? How do, let's say, a lot of these cats are signing
$100 million deals.
$100 million deals, $660 million deal. Granted, they're taxed in every city that they're playing, every
Right.
state pretty much. Stop 47%. So if they get signed for 160, but they're only making about 83 million of that.
Yep.
That's what they take home, right?
1,000%.
Now, can they save on that 47% that they're being taxed on? Is it possible to save on that, or could you save the money more so on the profit part? But I would want to start with the tax part, the 47%. Can you lessen that number?
Yeah, that's major. So yeah, what you're referring to is the jock tax. Okay.
Okay.
So what happens is, as an athlete, you can get taxed based on the different states and places that you pay, right? And one of the things that happened, the backstory with that is, it's interesting. So it was actually Michael Jordan, right? So Michael Jordan, he basically, it's originating from Michael Jordan. So Michael Jordan, he was playing all over the country, or whatever the case is. And basically, long story short, they hated on him, and basically they started taxing all the states that he played, right? So then they created this jock tax now where you're an athlete, you're being taxed on every state that you play. So one of the things that you need to do.
But why is that if that's not the place you actually reside in? I never understood that. I understand the concept, obviously, jock tax, but why am I getting taxed on places that I don't reside in?
Right.
Yeah, the reason is because you're generating revenue there, right? So basically, at the end of the day, when it comes to saving money on taxes, like the IRS, their main objective is to be able to create revenue, right? So they're trying to generate as much revenue as they can.
Right.
So if they can find opportunities to be able to tax you and be able to generate revenue, now they can do whatever they want to do, right? So one of the main goals and one of the most important things that people need to do is understand how to proactively save money on taxes. So when it comes to the athletes, there's a lot of strategies that you could do, right? Believe it or not, like when the tax code was created, there's over 70,000 pages in the tax code, right? And yeah, 70,000 pages, right? So if you were to print out the whole tax code, that's almost like
the size of this room.
literally longer than that, right?
Do you have to read it all?
Right. You're asking if I had to read it all?
Have you read it all or something?
I haven't. Listen.
You probably read the first page, in the middle.
I read the stuff that you need to know. So this is the thing about it, right? 90% of the tax code, believe it or not, is actually showing you how to not pay taxes, right? Less than 10% is actually telling you what you actually have to pay in taxes, right? So what people need to focus on is that 90%. Yeah, the not paying taxes part. So really the big ways to save, and this applies to athletes, this applies to regular individuals, right? Is there's 6 big ways to save money on taxes, right? So the first one is deductions. So figuring out, okay, how can you maximize your deductions? Deductions basically a tax write-off. So when people talking about writing off things on taxes, that's basically they're spending money and it reduces their taxable income.
For athletes, I'm strictly talking about the jock tax, right?
Yeah. So this could be applicable to athletes, right?
So basketball shoes.
Yeah.
What? So basketball shoes. So not necessarily, right? So one of the things that happens with athletes is they also get paid W-2, right? So as a W-2, it's a little bit more challenging to be able to.
Can you file exempt? I guess.
You
probably frown upon it, like why?
It depends on the specific situation, the individual. But what I could say, just generally speaking to the general population, the public, one of the things that you want to think about, right, especially as an athlete or someone who's getting paid as a W-2,
Right.
is that you want to.
Are you someone that doesn't have life insurance? Why leave anything up to chance in a worst case scenario? Luckily, Policy Genius makes finding the right policy simple, and their team of licensed experts are on hand to help you through it. Life insurance gives your family a safety net that they can cover expenses with, so they don't have to worry about money while getting back on their feet. I've had friends and family members that have passed away without life insurance. It's definitely left us with financial instabilities. Even if you already have a policy, it may not offer enough protection for your family's needs, and it may not follow you if you leave your job. With Policy Genius, you can find life insurance policies that start at just $292 per year for $1 million of coverage. Some options offer same-day approval and avoid unnecessary medical exams. Policy Genius knows how valuable your time is. Their technology makes it easy to compare life insurance quotes from America's top insurance in just a few clicks to find your lowest price. Policy Genius has licensed, award-winning agents who can help you find the best fit for your needs. They work for you, not the insurance companies. They don't have an incentive to recommend one insurer over another, so you can trust their guidance. Policy Genius is for parents, caregivers, and anyone else who has people who depend on them. They simplify the process of getting life insurance so you can protect the people you love. They got thousands of 5-star reviews on Google and Trustpilot. Your loved ones deserve a financial safety net. You deserve a smarter way to find and buy it. Head to policygenius.com/DSH or click the link in the description to get a free life insurance quote and see how much you could save. That's policygenius.com/DSH.
Make sure that you have some kind of business, okay? So the tax code actually favors business owners,
Come
entrepreneurs,
in as an entity.
right? Having an entity on the side, right?
Right.
Because what that allows you to do now is now you could basically turn your lifestyle into a tax write-off.
Can the NBA sign you as an entity versus an individual?
They generally, based on my understanding, you'll come in as as salaried.
Okay, but
So-
can they? So they can't sign. If they were to sign you, more be like on a subcontractor, because that's what mostly basketball players are,
Right.
But they're W-2.
Yeah, you'll get paid
But
as a W-2.
Even if
generally speaking.
even if you come in as an entity, they can't sign you as an entity, right?
They could. It's
negotiable, I think, right?
I don't know.
I think you could be signed as an entity. You should be able
I'm gonna
to,
say.
right?
I'm gonna say. I'm gonna say it's possible. I'm not gonna say it's impossible.
Okay.
I'm just generally speaking. I'm gonna say that when you're coming into it, it's mostly you're getting paid as a salaried individual.
Right.
So
Right.
from there, you start a business and then you write off.
Exactly. Yeah. So what you want to do, and this again applies to W-2 workers at a job, right? You want to go ahead and start that side hustle, right? Having a business on the side, because now the tax code opens up
so
for you.
stop
Go ahead.
right there. Is the NBA depositing your NBA checks into that business account?
No, because it's
No,
what you have to.
the reason why I'm asking is
Yeah.
because it's a process. So I want to go step by step. So
Yeah.
just in case people don't know, can that money from the NBA, whether it's hockey, NBA, NFL, baseball, can that money be directly deposited from the MLB or NBA to the business account? Is that possible?
It is possible. So
Okay.
it's possible, but generally speaking, it's going to be W-2.
Okay.
Is because basically the way it works with W-2 versus contractor is basically they control your schedule, right? So you have to be here at a certain time. You got to work these certain hours. It's basically you are under the control of the owner, right? So that's why you're getting paid. You're getting paid as a W-2, and because of that, now you have to pay payroll taxes on that. So again, like really the process is just, I'm speaking generally speaking, like of course on an individual basis, we don't know every single person's contract or every single entity or whatever the case is. So it depends on the individual, but
Gotcha.
just generally speaking, that's the way it goes where you're getting paid W-2. So what you want to do with that W-2 income is now start transferring that over into a business entity, right? And then that
So
business,
when you say transfer, am I doing wire transfers to that account?
it could be a wire transfer.
Okay.
It could be however you want to transfer that money. Because really, initially, when you're moving that money over from personal to business, that's considered a capital contribution. So now you're contributing to that account. So it's not taxable when you do that, right?
Oh,
You're just basically like investing into that business, right? To be able to get it going, get it started, whatever the case is. So what you want to do is you want to figure out, okay, how can I be able to write things off on taxes now as a business owner,
Okay, so
right?
now the money's in the account. Now we rock.
Exactly.
Okay,
Yeah.
so now what am I doing to get write-offs?
Yeah, so write-offs, really, when it comes to write-offs, there's 4 requirements, right?
Okay.
I call these tax-free requirements. So tax-free is an acronym I came up with to help people remember. So the first part of that free is for business, okay? So the expenses and what you're spending money on, it needs to be for your business. The next thing is our regular, right? So it needs to be considered regular for your business, okay? So it needs to make sense for your business. So depending on the type of business that you're in, you need to be able to figure out what is ordinary for that business. The IRS calls that ordinary. So for instance, one of my homegirls, she owns an ice cream shop, multi-million-dollar ice cream shop all across the country.
Mm-hmm.
She could write off ice cream cones, spoons, napkins, all those kind of things. If I try to write that off, right, I'm getting audited. I'm going to have some issues, right? Because it doesn't make sense for my business. So you want to make sure that it makes sense for your business. The third part of that is essential, right? So what's going to be essential for you to operate your business? The IRS calls that necessary. So necessary expenses are going to be rent, utilities, employees, hiring professionals, all
write-offs.
Yeah, all write-offs.
What about a
right?
car?
Car, 1,000%, right?
Write-off.
That could be ordinary.
The
That
whole
could be
car
necessary.
or just the notes?
The whole car. I'll break down. I'll
Okay.
break down the car because that one's powerful.
Okay.
And the fourth part of that is what I call economical. So economical just means it needs to make sense for how much money you're making in the business, right? So going back to that car, one of the things that 50 Cent did at the end of the year, he ended up owning a whole bunch of money, right? We know 50 Cent, he's a rapper, he's a producer, he's multi-millionaire, right? So what 50 Cent could write off is going to be different from what someone else could write off because 50 Cent has hundreds of millions of dollars. So he ended up buying 5 vehicles, wrote off all those vehicles.
Wow.
Because he's a business owner, he has these
And those
business
are
entities.
necessities.
He was able to categorize that as ordinary and necessary for his business, right?
Okay.
But if you're just starting off in business, maybe you could do one car, right? Maybe you might not be able to write off the whole car, but maybe you could do mileage, right? That's another way to do it. So there's different ways to do it depending on the individual. So those are the 4 requirements. It needs to be for your business, it needs to be regular for your business, essential for your business, and economical for your business. So going back to the vehicles, right? One of the things that you could do is you're able to write off the full amount of the vehicle, right? Again, if it's for your business, it meets those 4 requirements. You're able to write off the full amount of that.
So the vehicle does need to be paid off.
No,
Oh wow.
that's that's the secret, right? That's one of the most powerful things in the tax code is what's called depreciation. So depreciation is basically it's a cashless deduction, meaning that you don't have to put up money, you don't have to put up bread to be able to take it off. It's just based on the purchase price of the vehicle. So let's say, for instance, like a popular one is the G-Wagon, okay?
Yeah.
So the G-Wagon,
It's heavy.
Yeah, it's heavy, right? So
Yeah.
one of the requirements is the vehicle needs to weigh over 6,000
1,000
pounds
yeah.
in order to be able to write off the whole vehicle.
Right.
It used to be 100%. Now they brought it down to 80%. Right.
Why?
So
Do you know why?
because one of the things that happened is, so when Trump was in office, he came in, he made like the biggest changes in the tax code for the past 30 years, right? He did a whole bunch of things to benefit entrepreneurs, business owners, real estate investors, right? Trump's out of office. It's not a political discussion. He's out of office. So now they're trying to bring that stuff back. So now they're trying to change it back. But he got it to a point where you could do what's called bonus depreciation and what's called Section 179 that lets you write off 100% of the vehicle, right? So now they're bringing it back, and
Bonus depreciation is prior to the car depreciating.
bonus depreciation allows you to be able to write off basically 100% of
the
it.
car.
It lets you accelerate the depreciation, right? Because like I said, on one of the dope things about depreciation, this applies to homes as well, like investment properties as well.
Manufactured homes too.
Right, yeah.
Mobile
So
homes, yeah.
what's dope about it is that it's a cashless deduction for you, right? So you don't have to split up all the bread.
Yeah.
And again, you're able to write off the full thing. So let's just keep the math simple. Let's say 100% of the vehicle, right? So let's say 100% of the vehicle, you get a vehicle that weighs over 6,000 pounds. Let's say you're able to write off 100%. Like I said, it's 80 now, but let's say you were able to write off 100%. Even if you put down 10%, 20%, again, if you're using it 100% for business purposes, boom, you're able to write off the full amount of that vehicle. So that's how that goes.
Yeah.
So really, again, the thing is you just want to make sure you meet the 4 requirements. It needs to be for your business, regular for your business, essential for your business, and economical for your business. And then that's one of the ways to do it. And then
So
on
doing
top of
all
that, you could do the gas. You could do the gas, the
Yeah.
maintenance, the everything else that goes into maintaining that car for your business.
So doing in let's say an athlete does all that, right? Family, payroll, everything. When he sits down with his tax guy or CPA at the end of the year, he'll get a tax return. Based on the 47% that they took from him, he'll get a portion of that back because he has deductions.
Bingo.
So this is for after they take the 47%. This is how you recuperate those funds.
1,000%.
Okay, so I just wanted to make that clear for viewers. Yeah.
Yeah, so just to even piggyback and clarify that more. So what happens is during the year, right, especially if you're W-2,
Right.
you're automatically getting paid. You're automatically paying taxes during the year, right? So at the end of the year, if you could show, like, yo, I paid this much, but based on all these deductions that I have, y'all need to give me some money back, right?
Yeah.
So that's what happens when you really the tax return is just like a true up of what you ended up owing, right? So what happens is one of the biggest issues is that people think that the best time to save money on taxes during tax season, but it's too late.
The first time to save money is during the year.
It's during the year.
Yeah,
when
spending time.
It's tax planning. Now
Yeah.
being proactive, figuring out like
Gotcha.
if you didn't know how to write off the vehicle during the year, now we're in 2024. And you try to tell me like, yo, can I write off the vehicle for? No, bro, you did.
Have you seen cases where they took 47% and then at the end of the year, the person got the 47% or 30% that they took back the whole entire thing?
Yeah, it's possible.
That's fucking
Wow.
So check this out. So
that's technically not paying taxes.
No, you can get it down. Like, so one of the things Grant Cardone did it too. Grant Cardone,
He bought a
did
jet,
real estate.
right?
He bought it. Yeah, he bought the PJ, right?
Yeah.
So the jet, I forgot how much it was, but
I think it was over $1 million.
Yeah, over $1 million, right?
I think 20, I think.
Yeah.
Like that. Somebody said. Yeah.
Over $1 million. Again, met the 4 requirements for business, regular, essential, economical for his business, the business that he owns. At the end of the year, literally at the end of the year, he went and bought the whole jet, basically rolled up, got a big deduction, got money back.
Wow.
So my thing is, what happens the following year when you accumulate more? Are you just doubling down on spending and putouts, or what's that? I mean, or are you just doubling down? Like, okay,
No, not necessarily. So deductions is one way,
Yeah.
but there's other ways to be able to move and transfer your money to be able to save money on taxes. But basically, it requires like consistent planning and looking at your situation. Yeah, if you're gonna make more money, then now you got to figure out other ways to be able to reduce how much money you pay on taxes, right? So I'm not going to say that every year, like you're going to pay zero money in taxes, you're going to get money back, especially as an entrepreneur and a business owner. Just understand that you probably may end up owing some money on taxes.
Yeah.
The biggest thing is like figuring out how to
illegally avoid paying taxes.
Yeah. And avoid is key, right? Because
not evasion.
1,000%. Yeah.
Avoid.
Yeah. He knows. So you understand. So like, you got tax avoidance, you got tax evasion. Yeah. Tax avoidance is legal, right? That's basically reducing how much money you pay in taxes. Tax evasion is when you're saying you make less money than you actually made, or you say you're spending more money in deductions than you actually did, right? That's tax evasion, right? That's what you can get in
and
trouble
then you
with.
get audited, and then they find out you're not. Everything was a lie, but
Exactly.
the likelihood of them auditing you is not likely, but they will at some point. Yeah.
Is it true Native Americans don't pay tax?
So I'm not gonna say they don't pay tax, right? But they do have.
I heard that too.
Yeah.
They do. There are some benefits
To be a Native American.
Yeah, to be a Native American.
So I'm Native American too. You are. And
I'm
I'm not gonna go down that rabbit hole, but
evasion.
yeah, I'm not gonna get the people in trouble with that one.
Right.
But no, there's different things. There's different exceptions and rules. And like I said, that's what's so dope about it. It's like 90% of tax code is telling and showing people like how to not pay taxes, right?
Yeah.
Everyone's thinking about, I got to pay all this money in taxes, and if I don't pay money in taxes, either that makes me like unethical or I'm breaking the law somehow.
Yeah.
But that's not the case.
Yeah.
Like the wealthy and the rich understand like you
Avoid
can use
all
the
the
tax
time.
code. Yeah, you could avoid it, right? Because why? Like the reason why I push and tell people to do that is because I feel like you have a moral obligation to keep as much money as you can.
Right,
Now you
right.
can use it for your family. Now you can use it to give back to the community. Use the money the way you want to. Now you can use that to reinvest into the business and be able to provide jobs for people, right? You could get into real estate, right, and provide housing for people, right? So that's why it's so powerful to understand like how to be able to proactively save money on taxes.
What would you say would be a nice amount of entities to have attached to you as a normal person, not even as an athlete, just like the normal person walking around makes a decent amount of money? How many entities should he or she have attached to him?
Yeah, I wouldn't even go based on a number, but based on the different types of ways you can go ahead and create entities, right? So you're going to have one entity for an active business, okay? So like, let's say you have a consulting company or whatever the case is, you're going to want to have a separate legal entity for that, right? A legal entity is going to be what's called an LLC, limited liability company, or a corporation, right? Those are the two. Yeah. That's those S corp. I'll talk more about the S corp. The S corp is actually a tax entity. So that's how you're taxed. But the legal entity that gives you that legal protection, LLCs, corporations can do that.
Right.
Then you got your passive type of activities. Passive activities is going to be you investing into real estate, for instance, right? So you're going to go ahead and invest in real estate. Let's say you do buy and holds or whatever the case is. You want to go have
That's separate entities.
That's a separate.
Three. So
Yeah.
that's 3 you just said. Okay.
Yeah, so now we're at 3, right? And then you could also you can create more different, more complex types of entities depending on your situation. But I'll say the average person, like having an entity,
I think 5.
Yeah. You think the
5.
number is 5?
I think you should at least have 5 entities attached to you, whether separate standing or fictitious entities. Or I think you should have 5 different entities attached to you.
Yeah,
5 EINs.
I wouldn't put a number on it, but there is benefit to being able to do that, because like you said, even with the EINs, now that opens you up to being able to get business funding, business credit,
Yes.
and now reduces your risk now, right? Because
Yes.
what happens is now with these legal entities, right, someone tries to come after one business, they can't come after all the businesses, right? If you got to structure the right way, if you're doing the right things, you're not commingling funds and mixing things and trying to finesse too much, like, then now you're able to go ahead and have that legal protection. So that's super key. But going back to the S corp, that's super important. I want people to understand this too, right? So we talked about legal entities. You got the LLC and the corporation. Those are legal entities. That's how you're basically legally structured with the state.
Right. Because most people get those confused, LLCs and a corporation confused with an S corp.
1,000%.
Right. So explain the difference between the 3.
Yeah. So basically what happens is you have the legal entities, and those legal entities are basically registered with the state.
Right.
Then you got what are called tax entities. That's how you actually tax. That's what the IRS is looking at. So that's why, for tax purposes, LLCs are considered disregarded entities. When people are new in business, they're like, "Why is my entity considered disregarded? Is something wrong?" Like, no,
They can't tax it.
They don't even see it. It's not even. It's basically it's disregarded for tax purposes. But then you have your tax entities. How you're actually taxed is you can be taxed as a sole proprietorship, right? That's usually when you're in business by yourself, partnership business, and more than one person. The S corporation, okay? So the S corporation is going to be different. One of the benefits of the S corporation is now you're able to avoid self-employment tax, okay? So self-employment tax is the tax that they pay, basically the tax that you pay, which is 15.3% on the profit of the business, right? So let's say you didn't have an S corporation. Let's say you make $100,000 in profit in your sole proprietorship. 15.3% of that, which is Social Security, Medicare, all that kind of stuff that's included with that. Now you're paying $15,300 in taxes for your sole proprietorship. But now if you go ahead and switch over to that S corporation, what happens now is that instead of being taxed on the profit of the business, you're being taxed on the salary that you pay yourself. So that's one of the requirements. That's important for people to know. Is like, as an S corporation, you have to go ahead and create what's called a reasonable salary, right? Reasonable salary is just basically, if I had to give you a number, a good start to consider is 30% of the profit of the business, right? Minimum to start looking into, but you want to make sure you work with someone to like really crunch the numbers to figure out for you. But then what happens now is, because you're only paying yourself the self-employment of 15.3% on the salary, you basically, let's say you pay yourself $50,000. Now you reduce your tax bill by $7,000, right? You basically cut it in half because now you have that S corporation. So that's one of the benefits. So the time when people need to switch over to the S corporation is when you know that you're going to make more than $50,000 or really $40,000 in profit is when you need to switch over to the S corp, right? If you're just starting off, you don't think you're going to do $40,000 in profit, it may not make sense because it's going to be expensive for you, right? Now you got to pay fees, you got to put yourself on payroll, like the tax return is going to be more expensive for you to go ahead and process. So that is when you want to make that switch.
And when do you attach a 501c, right? When do you attach that and then start to allocate money there, because none of that money can be touched? When do you do that? Or it's no better time? You can do it whenever you want, as long as they approve the 501c.
Yeah, 100%. So yeah,
you know 501c, right?
Charity, right?
Yeah. So 501c3 nonprofit entity. Yeah, you want to make sure that you're starting it to be able to, have some kind of charitable, justify, like not necessarily a tax strategy. Not say people,
but
don't
it kind of is a tax strategy.
I
mean, I don't want to say it's a tax strategy.
Let me say this. No, check this out. No, check this out. So there's tax benefits. I'm not gonna call it. I'm just gonna
say a tax benefit. That's the better word.
CPA, because we're on camera, we're in public. I'm gonna say there's some tax benefits, tax incentives to benefiting the community. Why? Like just like anything, right? The tax code. What the government realized that the tax code, they can use it as an incentive system. So if they want you to do something, they're gonna go ahead and create incentives for you, right? So right now they're really pushing hard on the electric vehicles. So now they want people to pay. Now they're giving people credits for electric vehicles, and they want people to go ahead and invest in real estate. Why? Because as a real estate investor, you're providing housing. That's one less person that they have to put in public housing. As a business owner, you're providing jobs. That's one less person that they have to pay unemployment to, right? So you want to see what those benefits are, and the nonprofit, of course, is going to be a way for you to be able to help the government out by going ahead and putting money into that. So
Mhm.
that's something that if you have a heart, you know what I'm saying, to go ahead and contribute.
Is it true if you set up a trust, put all your assets, your real estate, LLCs in it, and you get sued, they can't go after that?
It depends, right? So when it comes to trust, there's different types of trust out there, right? So you have what's called a living trust, right, which is revocable trust. You have an irrevocable trust, okay? So the revocable trust basically is a living trust. Honestly, for a lot of people, that's what makes the most sense. At least that's a starting point. The revocable trust is basically what happens is one of the biggest benefits of the trust, not even getting into tax, we're going to talk about the tax piece with that. One of the biggest benefits of the trust is that if you just have a will, now you're going to have to go to probate, right? So when you die, when you become incapacitated, what happens is you got all this money, you got all these assets, right? People are trying to figure out, where's this money going? Like, who's getting this? Who's getting that, right? A whole bunch of families get into arguments because they don't know who's going to get what, right? So what happens is now you got to go through a court process called probate. Right. Probate is basically, people are fighting for years and spending all this money on attorney fees, lawyer fees, or whatever the case is. And the crazy thing about that is because now it's probate, you're going to court, and now it becomes public information. So now everybody can see, you got this, and right? So then what happens is, and what's really crazy is that sometimes even with that, because now it's public, right? There's literally people for their job, like people make a living, like literally just posted up by probate hearings or whatever the case is, and they hear about, this family can't pay for the property tax on the house.
Taking it.
I'm gonna take that. And then flip it, right? And pay. I'll just pay the little taxes on it.
They'll sell deeds all day.
Yeah,
wow.
It's crazy. It's messed up,
They'll
right?
Pay the property tax for $6,000 and then sell it for $12,000.
Whoa!
Just transfer the deed over. Somebody
That's
buy
wild.
it for $12,000.
Yeah, it's crazy.
Yeah.
So and the thing about it is, right? Even some of the most, and this happens unfortunately, like even like Prince, right? He died without a will. Like there's a whole bunch of celebrities and multimillionaires who even, I think, rest in peace to Offset.
I don't think he had a will.
Not Offset, my bad.
He didn't think he was gonna die. That's
Take off.
Yeah,
take off.
Yeah.
No, you but we're not thinking about that. But we just got to be prepared. We got to be in position, right?
Yeah.
So with that, like I said, that's a revocable trust, right? So it helps you be able to avoid probate, which is, again, you don't have to go to court. It's all documented, laid out for you. And then you could basically allocate it, and you could do what's called directives, basically saying, like, you can get really specific on how you want to do, right? So one thing that you want to put, like, I got a daughter now, right? So one of the things I could say is, like, hey, when I die, right, my assets can only go to her. It's not gonna go to her man. I don't want her. I don't know who this person is. Like, she's gonna get all of it, right? So that's something that you could be that specific, right? You could say that, hey, I don't want my kids because I know my kids are crazy. They're gonna blow the money, whatever the case is. I want to make sure that they go to college. I want to make sure they get it, like, before they can get the assets or whatever. So you can get really specific on how you want to do that. That's a revocable trust. Then you have the irrevocable trust. Irrevocable trust is basically, and it's a lot more complex, right? And doesn't make sense for everybody to go ahead and do this. But the irrevocable trust, that's when you're able to save money on taxes, because now you're basically in a position where they, the same own nothing, control everything.
Yeah.
That's what they're talking about, is the irrevocable trust, right? So with the irrevocable trust, yes, you can, same thing, you can go ahead and put assets in it, but now you don't necessarily, on paper, you don't own the trust, right? Someone else, you have a trustee, someone else that controls that, and then you can go ahead and start pulling out money, like through annuities or whatever that you have to pay taxes on. But now, in that case, that's what's going to give you the protection, right? So, and then you can get even more complex. So you
basically have assets, but it shows zero on paper.
Yeah, so you'll still report.
You have to trust your trustee, though.
Yeah, it has to.
Once you sign it over, bro, it's really not yours.
Yeah, it's basically irrevocable.
Oh, so you can't change it.
No,
you can't,
no.
That's like,
wow. So they can run off with it.
They can take everything from you.
Wow.
You can lose everything.
So it's got to be like your mom or brothers.
Not even that. Moms take stuff, brothers take stuff, girlfriends take stuff.
Yeah,
it got to be somebody that you have either the battery to their heart monitor. So if they take it, you can press the button and they drop it. But you got to trust them. I mean, really trust them. Even some people assign their attorneys as their trustee, their trusted attorneys.
And once you want to make sure it's like a separate entity, like some kind of like business, like maybe attorney or something like that. That's going to oversee it. They're basically in control of that. And with that, like I said, like I even had one client, right? You can get really creative with this, but there's, like I said, there's different types of trust. But I had one client, They just won the lottery, whatever the case is, right?
Wow.
Won the lottery.
How much they win?
They won $1 million. It's literally they were making
The scratch offs?
I forgot which one it was.
Because $1 million is not a lot with lottery.
Yeah.
Huh? He only paid $5, so I mean.
Yeah,
that's not like the mega jackpot as well.
Yeah,
I think what
I'm
you're
when he
referring
said
to-
lottery, I'm like 16, 30.
no,
18,
but he was making less.
100.
I think he was making less than 100K or whatever the case
Yeah,
is. So
yeah.
like, you know what
That's a
I'm
lot.
saying? This is
Yeah,
big
yeah.
money, and they basically took all of it, so they ended up getting half of it because when you basically decide to get like the full distribution,
Mhm.
you get 50% of that's taxed or whatever. Right, and that's another thing.
I'm
too.
cool with that. I would much rather take that
Right.
because you might end up, lottery winners die for some strange reason.
Yeah. So, but one of the benefits of the irrevocable trust is that you're able to be anonymous. So what they did was, he's like, I don't want nobody to know I won this money.
In what state though? Because every state you can be anonymous. California makes announcement. Ohio makes announcement. Texas makes announcements.
So yeah, you're right. So it depends on the state, but what he did was he got with an attorney, and this is like when we're going talking about trust, or whatever the case is, it's more of like a legal concept as well. So you want to
Yeah.
make sure you work with an
That's
estate
a crazy
planning
thing,
attorney.
though. That's
Yeah.
crazy. So
Yeah.
let
But
me ask you this. Well,
Go ahead.
before you start, so if I win the lottery,
Mhm.
am I starting the trust immediately, or am I doing it before I win? Like, when is a good time to start the trust, and then am I telling the state lottery, to transfer the money to the trust?
Yeah. So you can do it after the fact.
Okay, but
Yeah, you
just don't make
it's-
the
it's-
announcement.
Yeah, it's called like a transactional trust.
Okay,
Basically is what it is. So basically, it's
So
transactional.
transactional trust.
Yes,
I
it's
got
basically transactional in the sense that they go ahead and move the money in there so
Mhm.
no one knows who it is.
Yeah.
On paper, it's like the attorney, you know what I'm saying? Like really moving it so no one really knows what's going on, who has it. And then from there, then they go ahead and transfer the money.
you. And this is before you give them the winning ticket.
So as far as the timing is concerned, I believe so.
Yo, that's crazy.
Wow.
I'm learning
I didn't know
so
you could
much.
do that.
Yeah, I'm learning so much. So it's called a transactional trust.
Yeah.
So you do that immediately after winning the lottery, and it looks just like a bunch of paper scrambled, like a transaction to
Yeah, it's-
it's anonymous person.
Yeah, you wouldn't. Yeah.
So even when they announce me, it'll be like the Williams Trust Fund.
it would even
won the lottery.
but check this, it would probably even be their name, right? To keep it even
Yeah,
more
it'll just be
anonymous. So it'd be
something-
just like random, like
Some guy won it.
Yeah.
BCG Trust won the lottery.
Right. And you don't know who that is. Like,
If I
okay.
won it, I would be anonymous for sure.
No, for sure. Yeah, you don't want
Yeah.
that. You don't want that pressure. You know what I'm saying?
No, that's
Like,
crazy.
Definitely
yeah.
not.
So that's another benefit of the trust as well. So,
Transactional trust.
yeah.
Okay.
What's
So-
the most you've helped someone save?
the most
Over $1 million?
I think
I've been
hella,
able
man.
to show someone, about like 1.2. This is the thing about
that they
it.
got back or that you saved them.
I was able to save them in like tax savings or whatever
Mhm.
the case is. So this is the thing about it is like obviously the more money that you make, the more it's gonna be, right? So it's really
Mhm.
just like percentages, right? So the impact for one person is gonna be different for another person, right? So if I'm showing you like, hey, these are all the write-offs that you get, 30% of 10 million
Mhm.
is gonna be different for 30% of 100,000.
Right,
Okay,
right.
So it's really just
Percentage?
it's just percentage wise, right?
Mhm.
Based on how much money the person makes. But a really key thing with that is like when it comes to, again, saving money on taxes, that tax planning piece is really important because, again, and this is the thing about it, right? I'm a CPA, right? So certified public accountant, that's like one of the highest standards that you can go ahead and get in the accounting field, right? So
Yeah. It's tough to get.
yeah, it's tough, right? There's less than one. You have to get a bachelor's, you got to get a master's, you got to
Mhm.
work under CPA for 2 years. Has less than
Mhm.
50% passing rate. Less than 2% of CPAs are black. So it's like it's like basically the highest level, right? But
Congrats, brother.
appreciate you.
Congrats, man. Congrats on that.
That's love. I appreciate
Yeah,
that.
yeah,
So
yeah.
no, it's. But the thing about it is, even as a CPA,
Yeah.
I'm telling y'all, like right now, even as a CPA, CPAs don't even know how to help people save money on taxes.
Really?
Yeah. So this is the thing about like as a CPA.
So what are CPAs actually? Well, I know what some of you guys are good for because I done dealt with a lot of phenomenal CPAs, but
Right.
the fact that most people have that misconception that you guys are supposed to save them, they always applaud their CPAs.
No.
And is that a luxury, being knowledgeable about taxes, being a CPA at your level?
No, 1,000%.
Yeah.
Like because one of the things is like from my perspective is the CPA exam really prepared you to work in corporate America.
Mm.
So basically you're just working within businesses, whatever,
Yeah.
but they don't teach you and show you how to help business owners save money on taxes, right? So I had to invest like over $100,000s in myself, like learning from people, top tax attorneys and all these different things, right? To be able to learn this information, how people proactively save money on taxes, right? So I came up with this thing called the Tax Elite. It's another acronym that help people like really understand who you could work with, because the CPA is not enough, right? So as with the Tax Elite, the first part of that is education, right? So did they go to school for accounting or tax? They did. That's a positive thing. But then also, when you're working with a CPA, they need to be educating you on how to save money on taxes. So that's another thing. A lot of people, they just give their tax return and expecting that the CPA is going to save them money on taxes. It doesn't work that way. They need to be like, yo, Wayne, I see you got this and that going on. Like, this is how you need to move. Like, it needs to be a conversation or whatever the case. So that's, you need to be able to expect that. The next thing is legal representation. Legal representations, can they represent you in front of the IRS, right? So if you get a call, if you get audited, you don't want to be taking that call, right? Because one of the things that they understand, exactly, and they do it because they know you don't know. You don't. So they're gonna start asking you questions, and it's psychology, right? They're gonna play nice, like, hey, how you doing? Yeah, we just noticed that, if you and start asking you questions, and then next thing you know, you're gonna overshare whatever the case is and say things that you're not supposed to. Like, we got him, let's go. Right, and now you're gonna get hit with another tax bill. So legal representation, you want to make sure that you have a CPA. The CPAs can represent you. You want to make sure you have a CPA to go ahead and represent you. I is integrity. That's the next part of the elite. So I is integrity. Integrity means that someone that's following the tax code, doing things legally and ethically. You don't want to work with someone that's telling you to claim kids you don't have. Like, come on, like it's crazy. Like, this is what people really do in real life. Like, you know what I'm saying? So like, you want to make sure normal. So you want to make sure that you work with someone that's doing things legally and ethically. T is training. Are they constantly getting trained up on the latest and greatest tax information, tax code? That's going to be key. And last but not least, experience, right? So you want to look at years of experience, like how long they've been in the game. So I've been in the game for over 10 years, but then also you want to work with someone that has experience with your specific situation, right? Do they have experience working with real estate agents, real estate investors? What type of real estate investing? Are we talking about wholesaling? Are we talking about fixed and flips? Are we talking about buying holds? Like, are we talking about these? Like what are we talking about specifically, right? So that is going to be key, because every business, like I said, has different requirements of what's considered ordinary, what's considered necessary. There's some kind of benefits with a particular industry, so that's going to be key. So like making sure you're working with the right person. Like I said, the tax elites is who you need to be focused on.
Nice. What would you say the best places, just to kind of touch bases on that, are the best places to incorporate and then create nonprofits and outside of the U.S. too? Like,
so there's a couple of places that give you some more benefits as far as like registering. You got Wyoming. It's gonna be Nevada is actually good. So Vegas, Nevada's good. You got Delaware that gives you some tax incentives. Really more of the anonymous type of benefits as well. Outside the country, man, you got Puerto Rico, you got Turks and Caicos. Like a lot of the celebrities.
I haven't heard of Turks and Caicos. Okay.
Yeah, you got Turks. Dubai, it has some crazy tax benefits as well, incentives. So yeah, but again, you want to make sure.
What about Mexico, Belize?
So, I would say New Mexico. New Mexico has some benefits. So
not actually Mexico.
Nah, well, I mean, as far as like
benefits,
as far as saving money on tax, because it's a different country, you know what I mean? So like it's gonna be beneficial for you. But I would say again, you want to make sure like you talk to someone about your specific situation, because I don't want people to like just jump out there and start getting these entities or whatever the case is. But it needs to make it make sense or whatever the case. If you're just starting off, like you could literally just go ahead, start it in your state and where you're located. That's the ideal way to do it. And then as you feel like, or as you start moving up, then you want to start looking into those different strategies to be able to help you save.
Why do you recommend all parents pay their children a salary?
Oh man, that's like, so this is the thing about it. So when it comes to the money that we spend, right? Some of where we spend, a lot of people spend most of their money is on their kids, right? Kids are expensive. Like I said, I just have a daughter, and it costs, right?
How early should you start paying their salary?
That's a good question. So what I generally recommend publicly is, because there's a court case, and in that court case, there's basically a parent that paid their 7-year-old through the business, and they were cool with that. So anything younger than 7 starts to become a gray area. So I know people do it, and they say that the child is a model, and they try to do it that way. I personally recommend 7 years and older is when you want to look at that based on the court case, because the tax taxes, when it comes at the end of the day, tax is really law, right? So what I tell people all the time is, in order to change your tax, you got to change the facts, right? So it's based on the facts of the situation. What's the facts? Okay, you have your kid now is an employee, so that's the fact.
Right.
So now with that, you're able to pay them up to the standard deduction amount. So whatever the standard deduction amount is for the year, this year's $13,850.
Right.
You go ahead and you could pay them up to that amount. And based on that, they need to be performing legitimate business services for the business. You need to make sure they have a job description. You want to record their hours. The hours need to make sense. So basically with the hours, and just because, your kid, let's say for instance, you have your kid cleaning around the house or whatever the case is, you can't pay them $100 per hour, right? So you want to make sure you do research and figure out like what makes sense for how much work that they're doing, right? So that's one of the key things there. And then also, you just want to make it look, you want to have the documentation tight on that, right? So you want to make sure it makes sense. And one of the dope things about that is now the kid is able to have earned income. Because they have earned income, now you can go ahead and put that into a retirement account. Let's say you put it into a Roth IRA. Let's say you started at the age of 7, right? And let's say the rate of return on that happens to be like 10% or whatever the case is. You can even go lower than that, but just hypothetically speaking, let's say the rate of return over a 10-year period, they from 7 to 18, right? You go ahead and bring that out. By the time they're 18, they have over $100,000 in their bank account, right? From going ahead and being able to do this. So that's why I always push, being able to pay your kids through the business. One, it's a tax deduction for your business. So you save the money, you're not paying taxes on it, right? That's the tax loophole.
So is it okay if you pay a 7-year-old $100,000 a year?
Nah, bro. So one, like I said, it's up to the standard deduction amount, so $13,850, and then to be able to not pay taxes on that. Okay, so you can't.
I want my 7-year-old makes $100,000 a year. What's wrong with that?
But they can. What I'm saying, So I'm not saying you're not allowed to. What I'm saying is that the tax benefit that I'm talking about, the $13,850, that's the max that they're going to say that you don't have to pay tax. Anything over than that, then they're going to start.
So the kid doesn't have to pay taxes on that $13,800.
No. Wow, yeah. I never knew that. Because I got a little allowance when I was a kid.
Yeah. So that's the thing. Like, one of the things that people need to think about is not if you could write it off, but how can I write it off?
Okay, and how many kids can you put on that $13,800 salary?
How many employees do you want?
So you got 5. So you got 5 kids. You're able to pay them each $13,800.
But yeah, but remember this, right? Again, it's the economical piece. Like, how much money does your business make? So if your business only makes $5,000, like, you know what I'm saying?
Right. It's got to make sense.
Yeah, you can't. It has to make sense, and it has to make sense with the age too, right? So I'm not gonna tell you to jump out and pay a 7-year-old $13,850, right? Because the math ain't math, and it's gonna be a little bit harder. But like, if they're 15, 16, and they're your graphic designer, social media manager,
right?
We lit. 13,000. Like, go ahead and pay them the whole $13,850.
Now, what's this health insurance thing I see people doing where they're taking out loans against their policies?
Yeah, so there's different policies that are out there.
Health insurance?
Yeah, people are opening up health insurance accounts, putting money in it, and then taking money out interest free, right?
Yeah. So
is that Cure Credit?
So I would say this. So on the health insurance piece, I'll just say that's really more of a life insurance type of strategy. So generally speaking, people will do that with life insurance. So life insurance, if you get like a whole life policy, whatever the case is, there's policies that are out there that basically you're basically able to borrow against the cash value of that, right? So one of the things actually that's interesting is that Walt Disney, like, that's how one of the things that he did to be able to start Disney World, he's able to go ahead and use that. And because loans are non-taxable, then you're able to go ahead and borrow against that tax-free, right? So again,
well, that's life insurance.
But that's life insurance.
Yeah, that's life insurance. Loans are non-taxable, but anything you get from the bank is that's the deduction, especially if you're delinquent on it, right? The banks write it off. They have an insurance policy on every loan.
Yeah, right. Yeah. So for the banks, if they write it off, then it's basically a loss for the bank. Yeah.
That loan stuff is nuts though, because people would take money out, buy a house with it, and make more money.
Yeah. So one of the things you could do. So this is a really dope strategy that people can.
But it lowers your face value, right? Your face amount if you take a loan out against your whole life.
So one thing that you can go into like the borrowing, right, and being able to get homes, right. So one thing that someone could do, right, potentially be able to do is, like, let's say you're working at a job, right. You're working at a job. You have your 401k account, for instance, right. You go ahead, become a business owner. You go ahead and switch that over to a solo 401k, right? That's the 401k for business owners, right? Yeah. One of the things you could do is you can borrow against that retirement account, right? So you can borrow, I believe, up to 50% of that account.
Yeah.
Now you can go ahead, use that money, be able to buy property, right? And then basically be able to use the money, the cash flow from that from that property, go ahead and pay down the loan.
Back.
You get tenants in there, they're paying down the loan,
Yeah.
or whatever the case is. So yeah, that's another way
Wow.
to be able to
And
do
that's
it.
the
But again,
401k, right?
you can do that with the 401k.
You can borrow what is it 60% or 50?
50.
I'm gonna say
thought-
50.
thought
Yeah,
it was
it could be more, but I'm just gonna
Okay.
say 50. I don't want to misquote and get people
That's sick.
jammed up.
Michelle, what are you working on next, and where can people find you?
Yeah, man. Always got something going on. So
This is very informal. I actually really enjoyed this.
It was
It was
good.
tax. Some
Nice.
people may say it was
Listen.
boring, but I liked it a lot.
Nah, listen, like I scratched the surface on it, but yeah,
Mhm.
we can really go with it. One of the things, I want to share this because this is super key that I want people to understand, right? Before we wrap up with this, is like understanding tax, like literally your biggest ROI to increasing your wealth, okay? Because, and again, people don't realize this, but like tax is destroying most people's wealth, right? So think about this, right? When you make income, you pay income tax.
Yeah.
When you buy something, you pay sales tax. When you buy property, you pay property tax. When you sell the property for more than what you pay for it, you pay capital gains tax. When you die, because they tax you to death, now you're paying death tax, right? And you add up all these different taxes, that's over like 52% of your income. Like people are not even aware of this, right? So basically every dollar that you're making, that's 52 cents, $10, $5.10,
Right,
$100.
right.
Like it goes on and on, right? But the biggest tax that people don't talk about is what I call ignorance tax. And ignorance tax is the tax that you pay by not understanding the tax code, by not working with the right professionals. So for the listeners, for everyone out here, like I begging y'all, like really make sure you take this thing seriously and, you know, understand how to save money on taxes, because too many people are overpaying in taxes, and there's a lot of ways to be able to save. Like I said, the tax code, most of it is showing you how to save money on tax. So that's going to be key. But as far as what I'm working on, man, yeah, like I got a couple things. So one of the things I started is now I'm actually coaching and helping other people become what I call the tax elite. So helping people now, helping their clients be able to save money on taxes, right? There's over 7 billion people. I can't work with 7 billion people, whatever the case is, right? So I want to make sure I help the next generation of accounting and tax professionals. That's one thing. I also have an ebook that y'all definitely need to check out. So it's called Tax Wealth Secrets ebook. We're gonna have the link in the in the description. Make sure you guys tap into that. Got a special discount for the listeners, so you guys go ahead. Tax Wealth Secrets ebook .com is where you can go ahead and pick that up. And yeah, just continuing to educate folks and helping people save money on taxes is what I got going on, man. So yes, sir.
Oh yeah,
I loved it.
Yeah.
All right, guys. If you need help saving money on taxes, hit my man up. Thanks for watching. See you next time.
Peace.